Silicon Valley Bank, Signature Bank, chaos, banks closing, depositors freaking out, the investment community freaking out. What is going on here? Now that Joe Biden has spoken, he said that regulation was coming, new bank regs. What could it be? I've got some ideas. In this video, we're going to cover the three main areas that I think are ripe for new bank regulations or an enhancement to existing bank regs. These are the areas that specifically sent Silicon Valley Bank and Signature Bank into its tailspin spiral. The first of these areas is held to maturity assets. Now, just to give a brief primer on what exactly happened at Silicon Valley Bank, because it relates to these held to maturity assets. I think they were the core reason why Silicon Valley Bank went under. Banks work by borrowing short and lending long. What happens is a depositor comes in, gives a bank money, and a bank will then take that as a liability on its balance sheet. It needs an asset to counterbalance that liability in case the customer wants their money back. They need to put that money to work somehow. Typically, they would take that depositor money and lend it out. They'd like to lend long, right? Give a mortgage to somebody. And while that certainly did happen with Silicon Valley Bank, their core business of lending to businesses, like startups that were giving them the deposits, it just wasn't there because these startups, they were flush with venture capital money. So they didn't need any excess capital from Silicon Valley Bank. So what does a bank do in that situation? They buy long-dated treasuries, agency securities, more long-dated instruments, but those instruments, the problem is that they're exposed to interest rate risk. Now we'll get there, but the thing with these long-dated instruments, these securities that I just mentioned, is under accounting and applicable regulations, they're considered as held to maturity assets, which basically means that you do not need to report on the mark-to-market valuation on a daily basis of those securities. You can just hold them on your balance sheet at probably the mark that you bought it at and wait until you realize either a capital gain or a capital loss until you report it again. Now, generally speaking, that's fine because it's actually pretty safe to hold these assets given that they are backed by the federal government and the full faith and credit of the United States. So usually that wouldn't be a problem. But as interest rates started to rise and as the tech industry slowed down, there became kind of a perfect storm of consequences here that coalesced into more tech startups pulling deposits out. So they were holding less at Silicon Valley Bank. And then the assets that Silicon Valley Bank had on its balance sheet, those long-dated treasuries, what happens when interest rates go up? The valuation of bonds, they go down. So it's just an inverse relationship. So not only was Silicon Valley Bank losing money from its deposits, they then would have to cover those deposits by having to sell some of the assets that they had on its book. And those assets, they were trading at significant losses. So then Silicon Valley Bank has to report that as a capital loss to the investment public. Investors freak out, depositors see what's going on, and the Silicon Valley community then starts to talk, and soon we have a bank run. So that just kind of coalesced into this perfect storm of factors. But what it really comes down to is, I think, these held to maturity assets that they're not required to report a mark to market on a daily basis, which seems crazy. Like, we should have an idea of where your assets are if you're a publicly traded company on a daily basis. The investment public needs to know. So that's change number one that I would propose, is more transparency around held to maturity assets. Number two, the Dodd-Frank rollback. So in 2018, the Donald Trump administration, and I can't fully blame just Trump for this because it was a bipartisan effort to some degree. I think it was about 17 Democrats that signed on to this. But there was a bill to reform the Dodd-Frank Act that was passed in the Obama-Biden administration back in 2010 following the financial crisis. One of the key provisions of the Dodd-Frank Act was a threshold standard of $50 billion dollars in assets. So any bank that had 50 billion or more in assets was subject to a number of strict requirements, everything from stress testing, living wills, capital requirements. It was just, you were considered more systemically at risk for the economy if you were a bank of that size. What Trump and Congress did at that time, they looked at that and said, you know, this is just too onerous on smaller and regional banks. Let's bump up that threshold to 250 billion from 50. Guess what the asset valuation was of both Signature Bank and Silicon Valley Bank? Just guess. They both held under 250 billion in assets. So they weren't subject to stress testing on an annual basis. They weren't subject to living will requirements, which basically is like how they would dissolve in an orderly manner if they were to default. And they also weren't subject to stricter capital requirements that banks like JP Morgan, Bank of America, any bank that has over 250 billion in assets. That's pretty important. You know, you would think that a bank the size of Signature or Silicon Valley Bank, which were well over 100 billion, that they would need to undergo stress testing and that regulators would want to take closer peeks under the hood, because many other entities, from small businesses to just basic depositors, are relying on those banks to survive. So that's my second proposal, is moving that threshold back down to 50 million for some of the stricter Dodd-Frank requirements that I mentioned. My third and final recommendation for now, but if you're enjoying this, please make sure to subscribe and give me a like, and we'll keep coming with some more of this content as this situation unfolds, because I feel absolutely awful for any of the employees of Silicon Valley Bank and Signature Bank, many of whom I'm sure were just trying to do the right thing and do a good job. And then everybody that's lost money as a shareholder or bondholder. These are just tough times. And I mean, yeah, you can easily say, well, you should have known, should have done this, should have done that. It's easy to second guess in hindsight, but many of the people that have been detrimentally impacted here, it's important to remember we're trying to do the right thing, and not everybody has a crystal ball. So, or the wherewithal to know when there's serious systemic risk in the system, especially when regulators don't even characterize it as that for these types of banks. But number three, I would say, is the FDIC threshold for businesses. Now, there's an FDIC threshold for individuals. It's $250,000 in a depository account. So like a checking account, CD, savings account, anything up to $250,000 is insured. Now, there are exceptions, as we've seen. The federal government has guaranteed all deposits, as they announced recently for both Signature and Silicon Valley Bank. But generally speaking, it's $250,000, absent some extreme exception like what we just witnessed. But this raises the question, what's the threshold for businesses? A small business also, needs some assurances that they're not going to lose all of their money if they put it into a checking or savings business account at a financial institution like a Signature or Silicon Valley Bank. And after a cataclysmic event such as this, there needs to be more confidence and certainty added to the system. By putting a threshold at even just a few million, I think it would go a long way toward deterring people from instigating a bank run. And what happened with Silicon Valley Bank in particular, you've got a really close-knit community in the Valley that they all talk to each other, they all know each other, from the ventures to the startups, to people in some of the smaller tech companies. They all talk, right? So they, unbeknownst to them, basically started their own bank run with Silicon Valley Bank. Now, had some of those startups had assurances from FDIC that at least a few $1 million was guaranteed and backed by the federal government, they may not have been as incentivized to pull out as much money as rapidly as they did. They may have at least kept in the amount that they knew was going to be safe for FDIC purposes. So that would have potentially given Silicon Valley Bank more of a lifeline and allowed them to survive for just a bit longer to see another day. So in conclusion, those are my 3 recommendations, or what I think are some of the most important regulatory changes that could potentially come from this. But I'm really interested in what you think about the proposed changes I've come up with for held to maturity assets, about the Dodd-Frank rollback that I would roll forward once again to 50 billion threshold for greater regulation and stress testing for some of these smaller and regional banks. And number 3, for FDIC thresholds for small businesses in addition to those for individuals. Let me know in the comments what you think. We'll be coming out with more content on some of these types of issues in the near future, so be sure to click subscribe if you haven't already, and we'll see you on the next one. Cheers.